Have you ever wondered why that cool gadget you saw online from Europe costs more in dollars than it does in euros? Or why your vacation to Japan suddenly feels so expensive? The answer often lies in something called an exchange rate. It's a concept that impacts everything from international travel to global trade, and even the price of your everyday goods. So, what is an exchange rate, and why should you care? Simply put, an exchange rate is the value of one country's currency in relation to another. It tells you how much of one currency you need to buy one unit of another currency. Think of it like trading baseball cards. If a rare card is highly sought after, you might need to give up several common cards to get it. Currencies work the same way. Some are more in demand than others. Let's look at a simple example. Imagine you're planning a trip to Canada. You're in the US, and you need Canadian dollars to pay for things. Currently, let's say the exchange rate is 1.35 Canadian dollars per 1 US dollar. This means that for every $1 you exchange, you'll receive 1.35 Canadian dollars. If that souvenir t-shirt costs 20 Canadian dollars, you'd need to spend approximately 14.81 US dollars to buy it, 20 divided by 1.35. Now exchange rates aren't fixed. They constantly fluctuate, influenced by a complex web of factors. Think of it like a stock price. It goes up and down based on supply and demand, economic performance, and even political events. Why are exchange rates so important for us in the US? Well, a lot of what we buy comes from other countries. Everything from electronics and clothing to cars and food is often manufactured or sourced internationally. When the dollar is strong, meaning it can buy more of another currency, imported goods become cheaper. That's good news for consumers. We can get more for our money. However, a strong dollar can also hurt American exporters. If a US-made product is expensive in another country due to the exchange rate, it's less competitive and fewer people will buy it. Conversely, when the dollar is weak, imported goods become more expensive, but American exports become cheaper, potentially boosting our economy. Let's say you're buying a Japanese video game console that costs 30,000 Japanese yen. If the exchange rate is 140 yen per dollar, the console would cost you around $214.29, $30,000/140. But if the yen strengthens and the exchange rate shifts to 120 yen per dollar, that same console would now cost you $250, $30,000/120. See how the changing exchange rate directly impacts the price. Several factors influence these fluctuations. One major driver is interest rates. Higher interest rates in a country tend to attract foreign investment, increasing demand for that country's currency and driving up its value. Economic growth also plays a role. A strong and growing economy usually leads to a stronger currency. Inflation, which is the rate at which prices increase, also affects exchange rates. High inflation can erode a currency's value. Political stability is another crucial factor. Countries with stable governments and predictable policies tend to have stronger currencies. Finally, speculation. When traders buy or sell currencies based on anticipated future movements, can also create short-term fluctuations. Let's look at another example. Imagine a US company wants to buy goods from a company in the Eurozone. If the dollar is strong against the euro, the US company can get more euros for their dollars, making the goods cheaper. But if the dollar weakens, they'll need more dollars to buy the same amount of euros, increasing the cost of the goods. Now you might be wondering how these exchange rates are determined. Historically, exchange rates were often fixed, meaning governments would peg their currency to another currency or to gold. However, most major currencies today float freely, meaning their value is determined by supply and demand in the foreign exchange market. This market is huge. Trillions of dollars are traded every day, and involves banks, financial institutions, and individual traders. There are different types of exchange rates you might encounter. The spot rate is the current exchange rate for immediate delivery of a currency. The forward rate is an exchange rate agreed upon today for a future transaction. This allows businesses to lock in an exchange rate and protect themselves from potential fluctuations. Understanding exchange rates isn't just about international travel or trade. It also impacts investment decisions. If you're considering investing in foreign stocks or bonds, you need to consider the exchange rate risk, the possibility that the value of your investment will be affected by changes in the exchange rate. In summary, an exchange rate is the value of one currency in relation to another. It's constantly fluctuating, influenced by economic factors, political events, and market speculation. It impacts international trade, travel, and investment, and understanding it is crucial for anyone involved in the global economy. A strong dollar means cheaper imports but potentially more expensive exports. A weak dollar has the opposite effect. These rates are determined by supply and demand in a massive global market, and there are different types of rates depending on when the exchange will take place. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.